London's housing market is showing increasingly pronounced signs of strain, and for many, it feels like the city is entering a period of heightened uncertainty not seen in over a decade. The latest figures reveal that the average asking price for homes across the UK fell by 1.8% in just a single month, marking the sharpest November decline since the aftermath of the 2008 financial crisis. For London specifically, this decline is even more acute. The surge in property listings, combined with growing apprehension over the upcoming government budget, has put additional pressure on prices and shaken buyer confidence, leaving many homeowners and potential buyers on edge. The number of homes available for sale in London has risen to decade-high levels, giving buyers significantly more leverage than they've had in years. Where previously sellers could expect multiple offers above asking price within days, they now find themselves in a market where negotiating power has decisively shifted to the buyer. Buyer demand is softening, agreed sales are slowing, and sentiment across the city is increasingly cautious. Observers note that properties are staying on the market longer, with homes that once sold in weeks now taking months to secure a deal. Much of this hesitation stems from uncertainty surrounding the budget. Speculation is rife that the Chancellor may introduce new levies on high-value properties or fundamentally reshape property-related taxes. Potential changes to stamp duty, capital gains implications, or tax relief for certain property segments are prompting buyers to hit pause. This looming policy shift has created a climate where buyers are reluctant to commit, unsure if the price they pay today will still represent value tomorrow. Sellers, too, are hesitant, uncertain whether to hold out for potential pre-budget valuations or adjust expectations and lower asking prices to attract cautious buyers. Adding to the strain is a concerning trend known as downvaluations. Surveyors, acting on behalf of lenders, are increasingly valuing homes below the agreed sale price, sometimes by 10 to 15% less than buyers anticipated. This has a tangible effect. Buyers are often forced to renegotiate with sellers, increase their deposits to cover the shortfall, or in worst-case scenarios, walk away from deals entirely. Prime London areas, such as Kensington, Chelsea, and Westminster, are particularly affected, where luxury and high-value homes are now facing more scrutiny and slower sales than in previous years. For sellers, this creates heightened vulnerability. Properties that once sold almost instantly at a premium are now taking longer to move, often at reduced prices. The uncertainty over whether a sale will even complete has shaken traditional assumptions about London's property market. Confidence, once a cornerstone of the capital's real estate, is being tested in unprecedented ways. Real estate agents report that even well-priced properties in desirable areas now require more marketing effort, negotiation, and patience. The rental market in London is also under pressure, though the dynamics are slightly different. Rents continue to rise, but at a slower pace than in previous years. Tenants are increasingly spending a larger proportion of their income on housing than ever before, making affordability a central concern. Many potential buyers, priced out by high property costs and mortgage repayments, are forced to remain in rental accommodation longer. Meanwhile, stagnant wages, inflation, and rising living costs mean that rental growth is expected to plateau. This creates a complex squeeze. Buying becomes more difficult, renting is expensive, and households face a challenging balancing act in their budgets. At its core, London's housing ecosystem is under pressure on multiple fronts. Sale prices are softening, price growth is slowing, the cost of renting remains high, and government policy adds layers of uncertainty. What is driving this market chill? The answer is uncertainty in every direction. Buyers are hesitant, waiting to see how taxes and mortgage regulations might shift, particularly affecting high-value and luxury properties. Sellers, confronted with competing pressures, must decide whether to hold out in hopes of better prices or adjust expectations to attract buyers now. This tension has created a market standoff. Homes sit on the market longer, fewer sell at asking price, and both sides must navigate an unfamiliar and volatile landscape. Analysts warn that while London is not in freefall, the market is heading toward a significant correction. Mortgage affordability remains a central concern, particularly for those who purchased at the market peak in 2021 to 2022. Many homeowners now face higher interest rates, larger monthly repayments, and stretched household budgets. The combination of slower buyer activity, a growing surplus of properties, and rising costs of living is forming a perfect storm that exerts downward pressure on prices, especially in high-value areas of central and inner London. The contrast with northern cities such as Manchester, Leeds, Newcastle, and Liverpool is stark. While London's market is recalibrating, these northern regions continue to see steady growth and strong demand, highlighting a structural divergence in the UK property landscape. House prices in northern hotspots are being driven by affordability, relative economic stability, and strong employment markets. London, meanwhile, is entering a phase of structural adjustment that could redefine property norms and expectations for years to come. If interest rates rise further or if aggressive tax policies are implemented, price reductions could accelerate. Homeowners, investors, and developers alike may face mounting challenges as affordability, sentiment, and supply-demand dynamics collide. For developers, particularly in luxury or high-end segments, the margin for error is shrinking. Investors who rely on rental yield are similarly under pressure, as rents plateau while costs increase. So what does this mean for today's market participants? Sellers may need to reset expectations, realistically price their properties, and prepare for longer listing periods. Strategic pricing, professional marketing, and patience will be key in navigating the coming months. Buyers should proceed with caution, focusing on affordability, location, and the potential for further price corrections. Timing, careful budgeting, and professional guidance will be essential to avoid overpaying. Renters must consider long-term affordability. While more supply could alleviate competition slightly, rents remain high, and inflationary pressures persist, making careful planning essential. London's housing market is not facing an outright crash, but it is undergoing a sharp recalibration. Prices are softening, supply is abundant, and uncertainty is high. The next budget may act as a turning point, either stabilizing the market or introducing new challenges. Knowledge, vigilance, and strategic planning will be the most valuable tools in the coming months. Buyers, sellers, and renters alike must stay informed, act prudently, and plan carefully, because in this evolving market, timing, prudence, and preparation will define success. The coming months will likely define London's housing landscape for years. Those who act with foresight, research, and caution will be best positioned to navigate these turbulent waters. The era of predictable price growth in London may be over, but opportunities remain for those who understand the market dynamics and are prepared to make informed decisions. London's housing market is not crashing outright, but it is recalibrating sharply. Prices are softening. Supply is high. Uncertainty is elevated. The upcoming budget could be a turning point. It might stabilize the market or introduce further complications. Key takeaway: knowledge, vigilance, and careful planning are essential. Timing, prudence, and preparation will define success for buyers, sellers, renters, and investors alike. The next 6 to 12 months will likely shape London's property landscape for years. Those who stay informed, understand market dynamics, and act strategically will navigate this period successfully.